And at this point, it's my pleasure to introduce this next session, which is adapting today's technology for tomorrow's challenges. And it's going to be hosted by our panel moderator, a good friend for very many years, Mike Prokop, Managing Director for the Alliance Risk Group. He's also a very active working group leader for our content partners, the Committee of Chief Risk Officers. So with that, I'm going to turn the floor over to Mike to introduce his panel.
Well, thank you, Howard, and Stephen and Isaac. Thank you for your presentation. That was fantastic. It helps us actually lead into our first question, which I'll just get to in a moment. First off, I'd like to introduce your panelists for today, and we'll have them introduce themselves and tell a little bit about their company as well. Brock, would you like to go first, please?
Sure. So my name is Brock Mosovsky. I'm the co-founder and VP of Analytics of Sequant.io. My background's mostly in energy. I've been in the energy space now for about a decade, mostly on the wholesale power side, doing anything from risk management, portfolio analysis, long-term forecasting of asset value, and really total portfolio analysis. And that's really related to what we do at Sequant. And so for those who may not be familiar with Sequant, Sequant is a cloud-native software as a service organization for energy analytics. And so we work with a variety of different stakeholders across the energy industry, regulated utilities, independent power producers, organizations that are looking to procure renewable energy for to meet sustainability goals, trading shops, consultancies. And really what we focus on is total portfolio analysis. We focus on assessing and analyzing all the different risk factors and the uncertain quantities within the portfolio, and then helping our clients to optimize that through advanced analytics that runs in the cloud. So it's a pleasure to be here. You know, thanks to Mike and Howard and Commodities people for hosting this great forum, and I'm looking forward to the discussion.
Thank you. Great to have you here. And Samir, would you like to do the same, please?
Absolutely. Hi, everybody. I'm Samir Saleja, founder and head of product at Molecule Software. For those of you who might not be familiar, Molecule is the modern cloud-native ETRM, CTRM system. We were born in the cloud, and we built our foundations on leading-edge technology. So we could do things like real-time position P&L, near real-time VAR, and pre-built integrations to other systems like Sequant. Today, we value $80 billion worth of physical trades and financial derivatives across 50 commodities daily: power, gas, crude, refined products, ag, softs, metals, chemicals, and more for plenty of companies you know. So feel free to check us out at www.molecule.io.
Very good, sir, and thank you. And I believe you just made it blatantly clear to the participants here today that we are now making that transition from the great presentation that Jura just did, from what they experience in this environment, now to the people that actually have the systems. So with that, what I'd also like to add is you saw Stephen and Isaac start to talk about integrated risk management. One of the things that the CCRO is doing is focusing on that a great deal, that as they very rightly said and pointed out, it is becoming blatantly and incredibly important that those silos between the different areas come down and communication and transparency increases. We are experiencing a number of big events in the marketplace, and systems like your own are a part of managing that risk, predicting that risk, and things like that. So what I would say for our first question is, we have talked about that interest in the market to adopt integrated risk management as an approach away from even enterprise risk management. Brock, maybe you could start us off. How are your platforms adopting to this transition, please?
Yeah, it's a great segue into talking about some of the systems. And I think that Isaac and Stephen keyed that up very nicely. The kind of the last point that they made with that really nice slide that shows all the different systems within an organization and how they're connected, I think is really telling. And one of the biggest things that we're seeing is that with the rapid pace of change within the energy industry today, with the transition to renewables and with regulatory changing constantly and different market mechanisms kind of coming online and being available to practitioners, you have to be able to kind of keep pace with that change. And that's hitting all the different components of the organization. And so part of the integration component is really one of integrating those pipelines, right? And that idea of building this system where all the different components, the ETRM, the ERP, the sophisticated quantitative analytics, all of those systems can talk to each other seamlessly, is something that traditionally has been very bespoke and has kind of come in the implementation phase. But I think that part of that transition toward a more integrated approach to risk management comes along with a transition to more modular and flexible systems. And I know that's something that has been at the very core of Sequant from the very beginning, is the idea of modularity and flexibility, the ability to kind of integrate with these other systems through modern architectures like RESTful APIs, housing systems in the cloud so that they can scale up and they can scale out at a moment's notice, to be able to have the kind of computational firepower that you need, but to not keep that up 24/7, right? It's very similar to the energy industry itself in terms of peaking resource needs. These systems don't just kind of crank out, computation 24 hours a day. They do it at certain times. And so being able to kind of leverage that modularity and the integratability with other systems, and then to kind of unify the views of the market across different, disparate silos within the organization, kind of break down those silos between front office and middle office and back office. That's a big thing that we're seeing as well, is that a lot of our clients are kind of integrating some of those with a single analytic tool, a single source of truth that can serve the traders, it can serve the risk managers, and then it can also serve accounting and treasury in terms of looking at settlements. And so I think that integration component is a really key one.
Yeah, the bar is pretty high for us as well. I mean, I used to work at another one of the big SIs before this, and the requests that we get today are so far away from what we were asked before. They're more like, oh, don't you integrate into these 17 platforms that we need you to integrate to? And the answer has to be yes. So the bar's pretty high these days, and for companies to be able to do what they need to do with their energy data, everything from analytics to asset modeling to just core ETRM functions and integrations with ERPs, et cetera. Companies deserve what they need, and what they need is a lot. Oh, you're on mute, Mike.
I didn't want any noise to interrupt you. Thank you. So one of the things I did want to point out again from a risk standpoint, though, and unfortunately, it's coming all too apparent right now. Apparently, there's some mass cyber attacks this morning in the Ukraine. So as people think about this, Jira was very good to talk about, and saw on the lower right, that the mass data lakes of data, right, that are being analyzed, brought in, sent out to regulators, all those types of things. There's a lot of input and output. And always, as you look toward that integrated risk management solution, consider cyber. Our cyber folks work very hard. They tend to be a little bit siloed as well. But that information sharing and transparency and that holistic approach to risk can really pay off in today's environment. So, which brings us to those types of challenges. And our second question, which is really, how has this current energy transition affected your business, and what challenges are you hearing about from your clients? Samir, would you like to start us there, please?
Sure. I think faster than we expected, we've had calls from customers saying, hey, we're spinning up a carbon group. Hey, we're spinning up a renewables group. Hey, can I shove my RECs in the system? Or even, hey, we've acquired batteries, and how do we model them here and make sure that we're modeling the transactions appropriately? One thing we learned early on at Molecule is that the ETRM is no good unless it can model everything, and so we've had to adapt very quickly to model really new things that are coming on real time as customers have ESG mandates, as customers have interest in battery storage and interest in carbon and renewables as well. So we've been playing in that space for a couple, 3-4 years now. And and it's not as if we've just covered everything. The change is accelerating.
Very good, Brian.
Yeah, I see so many of the same things with Sequant's customers. I mean, I think that with the energy transition, there's clearly a move toward renewable energy. I think everyone is asking how we can get more value out of batteries. The idea that you are tracking a lot more than just megawatt hours and dollars. You're tracking renewable energy certificates, and in some cases, even bucketing those. California manages PCC 1, 2, and 3 different buckets of RECs, different classes. You have resource adequacy requirements, again, flex, local, system, right? You have carbon free, which is a little bit similar to RECs, but a little bit different in some ways. You have all these different kind of attributes across the portfolio that need to be tracked. And you're also managing portfolios that are increasingly non-dispatchable, right? You're losing control over the energy that is being generated, whether you're a corporate that is procuring power purchase agreements or an independent power producer or a utility. We're seeing the trend towards renewables, and we're seeing organizations ask, what does that mean for me, right? And one of the things that I think is common to everyone is that it means a loss of control, because we can't control when the sun shines and when the wind blows. I think that's one of the cases where having the quantitative analytics to kind of support those decisions becomes really important. But the other thing I'll echo in what Samir said is that the pace of change is accelerating. I mean, we're seeing, since we've been working with organizations in California, we do a lot of work with community choice aggregators in California, and their space is evolving so rapidly. I mean, the regulatory requirements on them to track resource adequacy, carbon-free credits, all their supply and demand is constantly changing. And so we're getting requests all the time to kind of, like Samir indicated, we want to track our RECs. We want to track 3 different buckets of RECs. We want to track this thing that's similar to a REC, but slightly different and has all these intricacies, and we need you guys to do it. And so kind of the undercurrent there is that solutions need to be flexible enough to accommodate those changes. They need to be able to respond really quickly. And I think one of the best ways to do that is to kind of maintain a focus on modularity and flexibility. The days of big deployable kind of enterprise systems, software that sits on-prem on servers that are dedicated for the purpose, I think those are largely gone. And the industry is kind of moving toward a paradigm that is much more flexible, much more integratable, and acknowledging this idea that no one system is going to be able to do everything, and that the pace of change is rapidly accelerating. And so to keep up with that takes a certain architecture.
And just to build on what Brock said, right, the pace of change is fast enough that, at least, again, from the system side, it's not as if we're going to get a call from a customer saying, hey, we're thinking about spinning up a carbon desk 6 months from now. It's more like, we just did these trades, and here are the ISDAs. How do we get them in? And by the way, our reporting deadline is next Monday. So can you help?
I sense collective chuckles across the participants right now. So yeah, I think we're in good company.
Yeah, it's always this needs to be in here yesterday. This is happening now. Our hand has been forced, and what can you guys do for us? And so, if organizations are not able to meet those needs, then I think they're going to see clients migrate to other more flexible organizations that can. So it's something that I think is spurred on by the energy transition, but it's changing the way that technology and software companies have to operate their business.
But academically, it's just so fascinating.
Mm-hmm. No, it really is, and I think it comes down to also the rate now that we're seeing new products coming into the marketplace, from tradable products, management products, and things like that. Not only just systems, but also opportunities and changing market dynamics globally, from opportunities to fill gaps or perhaps exit out of different markets and things like that. Which kind of leads me to my next question. So, what makes these new products and new needs unique to what we are doing now from a systems perspective specifically, if you could please. Brock, again, if you could start us off there, please.
Sure. Yeah, I think one of the big things that we're seeing is that some of the kind of standard traded products are becoming less relevant to an extent. And when I say standard traded products, I mean block forward contracts for power, peak and off peak, and even the name peak itself is starting to get a little bit fuzzy because peak was meant to indicate the peak of the demand, but also the peak of the pricing, right? That was the period in which pricing exposure was the highest. And in some cases, we've actually seen those invert, where peak prices on average are settling below off-peak prices. And that's because of things like solar energy in the middle of the day that's really dragging down those prices with zero marginal cost generation. So I think that there's a huge shift in the way that energy is traded and will be traded. We're seeing a lot more very, very bespoke, customized shapes being offered into the market. And the premiums really are not as high as maybe I would have thought initially for a completely bespoke project shape. I mean, some of our clients will go to the market and say, here's the shape of my net short position. And once they know the shape of their net short position or the expected shape, they can go and say, who wants to offer me energy with exactly that shape, every single, 12 by 24 shape, or even an 8760. And organizations are coming back, they're getting responses, and the premiums that they're paying for those types of products are not exorbitant relative to standard peak and off peak products. And so there's a ton of value to organizations in the ability to align their supply and demand at an extremely granular level. And that's all financial. Then you bring in kind of the component of battery storage and the ability of batteries to kind of shift that energy around and do that alignment. There's also a lot of organizations that are looking at, 24/7 alignment of supply and demand just because they want to show that commitment to sustainability. Microsoft has been one that's been very open in terms of some of their marketing material to say their goal is 24/7 renewable energy. They want to match every megawatt hour they're consuming by a megawatt hour that's produced at the same time and in the same region. And that's very different from just tallying up the megawatt hours and the RECs that you've generated over a year and saying, yep, for 2022, I generated just as much renewable energy as I consumed, right? Because as we know, the impact of generating electricity is a very locational impact, but it's also one that varies by time. And so there's this kind of increasing trend toward granularity. It's creating a need for new products and new analysis to support that.
Now, thank you, Brock. And if I may, Samir, I'm going to ask for your comment in just a moment. But while Samir is commenting, Brock, if you wouldn't mind reading, there's a question that came in on the chat from a participant that actually is very relative to what you were just talking about. And I'd like to have you expand on that in just a moment after Samir gives his thoughts on what's being said now. Samir, would you like to go ahead, please? Oh,
sure. So, that Brock's comment leads right into high performance computing and how it's being used as I guess you'd call it a demand sink. And how it relates to off-peak power, how it relates to crypto mining, et cetera. We've heard some just absolutely fascinating things, like discussions of a crypto crack, for example. Natural gas to power to the mined coin, and decisions around how to run the miner, et cetera. Oh man, when we talk to folks in the industry about what we hear, it's clear that people have taken these concepts sort of really to the next level, to a point where shoving it into the existing platform is going to be difficult. But further, back to the original question, the pace of change is extremely fast.
Well said. And I think you might have, thank you, Samir. That's very present. So, Brock, if you wouldn't mind, you may have taken a look at that question. And if you could just kind of summarize a little bit what the question was and then what you would say to it.
Yeah, so the question was regarding this idea of really accelerating pace of change, especially in the electricity and carbon market. And so the question was really, how are ETRMs and analytic systems adjusting to the flexibility that's needed? For example, electricity, traditionally, you could assume that there was no storage. It needed to be generated at the exact time of consumption. Now that assumption may be changing at least a little bit with battery storage becoming more feasible. And so how are systems, adjusting to that? And I think the answer, goes back to some of the points that were made earlier about flexibility and modularity, because, suppose you have a system that is very, monolithic. It's deployed on premise. There's potentially different custom code bases that are deployed to every single organization that is using this software. And you have a new change where you want to be able to accommodate battery storage, or you want to be able to model, renewable energy certificates, or new power purchase agreement structures like, proxy generation swaps, or some of these new things that we're seeing coming on and starting to gain adoption. In order to actually deliver that to the customer, you now have to kind of update all those custom code bases, and you have to go through the customer's IT process to get it into the server that's on-prem and kind of behind their own firewall. That takes a lot of time, and it takes a lot of coordination across both of the organizations. So having kind of a centralized system with a single code base where all of the customers who are accessing the analytics or the software solution can access that system in the cloud seamlessly allows that organization like Sequant to deploy these updates in an extremely rapid fashion. A lot of times we're getting these requests and we're able to kind of turn around and update within one release cycle, which for us is every 2 weeks. We're continuously releasing, we're continuously updating the software. And so that flexibility in terms of the architecture of the entire software becomes just as important as the flexibility in being able to kind of develop these new analytics, because you can develop an analytic model reasonably rapidly, but if the only way you can run it is you can have your quant run it at the command line on their local computer, it's going to be of limited use, right? It needs to be integrated, and it needs to kind of flow through in a way that's transparent and usable. And so I think that's a huge component of this, is keeping up with that pace of change really requires an architecture at the very foundational level of the entire business to be able to support these changes and to deliver these changes in a very robust framework in near real time.
A great example of that, Brock, was, on our end was when crude went negative last year without much warning. CME had started publishing, CME and ICE, I think both were starting to publish warnings in the days prior, like, hey, here's what's going to happen. We're going to switch to Bachelier for the crude options. If it crosses this threshold, everybody thought we had 4 or 5 days. We had one. We were fortunate in that we were able to roll out a release very quickly, I think within a day or two, that covered that scenario. But I mean, that was a great example of change happening very fast.
Absolutely correct.
Sure.
Thank you. Staying with one of our other questions here that we have for you, and please, for the audience, keep the questions coming. We have another one in the queue we'll ask in a moment. But for both of you, what are the top 3 drivers in the market that has companies out exploring new analytics and risk management systems right now in your purview? And Samir, maybe you could start us off here, please.
Sure. I think the big 3 that we're seeing are renewables, carbon, 4, renewables, carbon credits, and crypto. Those are the places that we're seeing a lot of growth. And I get asked from time to time by larger, maybe possibly older trading companies, hey, are people actually doing these things? Especially when I mention carbon and crypto, the answer is absolutely, and they've been doing it for a while. So those are probably the 4 big spaces we see. And what's really interesting is the fascinating ways that all 4 link together in ways that if you really think about it, you could probably get your mind around, but wouldn't be obvious at first. Such as how, crypto mining might connect with high performance computing, which might connect with intermittent renewable generation, and how to link it all together.
Answer. Brock, would you like to
expand? Yeah. So I think what we're seeing in terms of the top three kind of overlaps with Samir's. Renewables and carbon are huge. Everyone is asking about those regardless of the nature of the organization. The other big one for us is batteries. And I would put high performance computing and or Bitcoin as kind of a rising trend. What I think all of these are doing together is that they're creating the need for new ways of analyzing portfolios, new models, new paradigms, right? I mean, like Samir was saying, when you think about Bitcoin, you think, okay, well, it's such an energy intensive process. We're running these servers to create these Bitcoins. But when you move a Bitcoin mining facility next to a wind farm that is losing a ton of money for the off-taker because prices are so depressed in the region because there's so much wind, you create actually a new market opportunity to arbitrage energy into cryptocurrency or other high performance computing computational outputs, right? You're effectively, what you're doing with high performance computing is you're taking electricity and you're converting it into data. And that data has value. And that's essentially what Bitcoin is, right? So we're seeing organizations ask that same question. Bitcoin's almost operating like a reverse battery in some cases, co-sited with renewable energy, right? Whereas a battery can store energy and shift when it hits the grid, the crypto miner or the high performance computing, it's not just crypto, it's computer vision, it's any application that requires a lot of processing power to deliver value. But it's able to operate as almost like a reverse battery. And what I mean is that it makes money when you're consuming energy because you're converting that energy into high value computational output. Similarly with batteries, right? Batteries are shifting energy around. They're trying to stabilize revenue. They act as a risk mitigation strategy, but they also act as a revenue uplift, especially for renewable energy resources that might be out of the money. And then renewables in general, right? Just looking at the different way that you have to manage a portfolio that is very, very heavy in renewables because you don't have control over it. You just don't, right? You have to understand the statistics because you only have control over your portfolio right before you contract for renewable energy. So you have to understand the statistical nature of what you're bringing into the portfolio, not only in terms of the resource itself, but also in terms of the market pricing that it's exposed to. And so all of those, I think those are definitely some of the biggest questions that we're getting asked. And, along the lines of that flexibility comment that was made earlier, we have a huge focus on developing our analytics very rapidly and evolving it very rapidly to keep pace with that.
Very good. Well, thank you. A question comes in from the audience here that I think is also relevant to what we're saying. And it's back to classic risk modeling. So I'll let you two decide who wants to take it first. But let me read, with the degree of complexity being modeled for renewables and power in general, how is the risk and pricing being handled for forecasting, VAR, and general mark-to-market computations? Are new models being implemented, or is AI and ML being used to supplement the valuations?
No, I'll just maybe weigh in briefly and let Brock run with it because I think he's going to have a way better answer. I mean, I think people are still figuring that out, and to some degree, people are designing their own forward curves that contain components of, nodal electricity, forward derivatives of things from CME and expansive and other places, probably smashing them together to form their own forecasts, and then feeding them into systems that work like they always did. But Brock, I'd love to hear what you have to say.
Yeah. When you talk about the complexity inherent and the lack of control inherent in things like renewable energy, battery storage, even carbon and some of these other attribute tracking, some of the traditional methods of doing mark to market kind of break down. And it's related to some of those, to the notion that I mentioned earlier about this idea of peak and off-peak pricing. Just kind of, it's almost not even relevant anymore. And I think it'll become increasingly less relevant. So if your mark to market and your VAR is looking at forward contract prices for block-shaped products and looking at market volatility and current market price, and you're using that to value even just the mark to market component, which is arguably a little more simple than even assessing risk, right? But even just determining that value, because the value of these things, renewables, batteries, even marginal carbon on the grid, is so tied to the real-time shape of the generation, which you can't control, and the market prices, which you can't control. And the two are actually they co-vary, right? The more renewable generation that is on the grid, the lower that price is. And so not only is there a shape that does not match typical over-the-counter traded products or exchange-traded products, there's also a covariance that is very, very difficult to capture in kind of a standard VAR metric. So there are new metrics being developed. The metric that we really recommend is one called net position at risk. But the idea behind these metrics is that you're looking at all the hourly variability of the generation volume. So there's extreme volumetric uncertainty, another thing that VAR models have a hard time capturing. But there's also extreme price uncertainty in the spot market and in the forward market. And then the two affect each other. They're not even decoupled, right? So you have to have a framework that models all of that. And you have to model it at the hourly level and then roll it up. It was kind of related to something that Isaac had said earlier, is that the means are summative, but you can't sum the quantiles. If you're looking at risk in your distribution, you can't just take your P5s across your different assets and sum them up, right? That gives you a very, very skewed view of risk. So you need to approach the problem much more holistically, and you have to approach it from a very, very granular perspective, accounting for both the physical nature of the grid and the way that these different risk factors can move, but also the nature of a particular portfolio that's responding to that. And so it becomes a problem of kind of impulse response, stimulus response for a particular portfolio or a particular class of assets.
Very good. Fantastic answer, because you just led into another question that came in from a listener. So I'm excited to see that our listeners are really participating today and sending us great questions. And it expands on a little bit of just what we just said. So here it is. If you're sitting on a monolith, if you will, that costs many years of time and money, what are your thoughts on how to move towards modularity, and how do you pitch this to leadership? And this actually preempts a question we were going to ask prepared around, how do you calculate that ROI and present that to leadership? Samir, perhaps, would you like to take a shot?
Yeah, sure. It's a hard case to make to rip out a monolith, right? Because exactly because of what the listener or the questioner made the question about. Lots of treasure and time and effort put in. And so one of the things that we've seen people do is say, okay, well, I have this new portfolio. It doesn't fit into my thing. Can I call somebody who can get me off the ground very quickly? And the answer is those people exist. Put the new portfolio into the new platform and justify. One way to justify the use of the new platform is, well, this is what enabled me to get my new portfolio off the ground, or this is what enabled me to meet my ESG targets, or something like that. That case, we've seen that case made over and over. And then at some future point in time, if you like the new platform and want to start migrating things over to it, that's great. But this next gen of systems is nowhere near as hard as the ones that came before.
That is such a good point. I just, anecdotally, we had a customer come to us in this exact situation. Maybe it was 2 weeks ago, and they had a solution that was on-prem. It was running on their own hardware. It was a good solution for certain things, but it wasn't flexible enough to kind of keep up with some of these, with the renewables and the batteries that this organization wanted to add to its portfolio. And so we started talking to them, and they expressed the same concern. They said, well, it's going to be a hard sell to move off of what we have, because we've spent millions of dollars over the years getting up and running on this system. And we said, well, why don't you give us an asset? Give us an asset or a small portfolio, and we'll just show you what the system can do. It's very easy for us to do this. And we turned the analysis around in 2 days. And they said, what, you did that analysis in 2 days? And we said, well, yeah. The implementation timeframes that we're talking about now are not years like they used to be. They're weeks or months at most, and that includes training for all the users to be able to use the system, right? So I think one of the big things is that supports kind of this transition is take your PTSD that has come from the implementation of that monolithic software and just acknowledge that you have to get over the trauma of implementing that because the implementations of today are not the implementations of yesterday. I think the other argument is one it's tough to sell. It's a very rational argument, but there's this idea of sunk cost. And a big system that is implemented but does not suit the needs of the business should not be adhered to on a go-forward basis just because you spent a lot of money on it, right? That cost is sunk. It's gone. It's spent. Now the question is, what do I do for the business into the future? How do I best position my business into the future? And if you're looking at that system and you're having trouble getting updates that can support the rapid pace of change, and you're not able to model your whole portfolio, and you're looking at this growing segment of your portfolio in renewables and batteries and attributes that you can't fit into that, it's a square peg that you can't fit into the round hole that you have to acknowledge at some point that going forward, you're going to have to make a change. And the longer you adhere to that solution, you're only hurting yourself in the sense of being able to move down that path and get on a path that's going to be better for you in the long run. So there's this idea of sunk cost. It ends up being, it's a very rational argument to a very emotional problem. And so it can be a hard sell, but there's an organizational change management component of this that's very difficult to navigate. It's an interesting problem.
And that's for sure very well said. Thank you. All right, here's our next question. Samir, you started getting us down this track, and it's some of my old stomping grounds. So I'm going to make sure I want to get this out because to set the stage a little bit, things like Bitcoin, digital assets, power it takes to create Bitcoin, blockchain in general, and some of the operational benefits of blockchain. Take, for example, some of the great things that in Houston, Blockchain for Energy is doing, a number of major corporations coming together to look at real solutions, real answers using this technology. It's no longer smoke and mirrors. It's hitting the ground and running. So let me ask you, how are companies that you've been speaking with, Samir, right now approaching blockchain technology, and how are they handling it from a systems perspective as well?
Absolutely. So, first of all, just on the purely crypto side, companies are trading crypto today. Absolutely. Respectable energy companies that are absolutely doing it. Second, on the purely blockchain side, the places that we see companies dipping their toes in the water, because everybody seems to be dipping their toes in the water, are around traceability and around settlements, typically. So, the confirms and settlements process being very difficult, being very labor intensive, really being something that should be able to be solved with a trusted third-party source of information. Absolutely a place where companies like VACT and Eliox, for example, are dipping their toes in the water. And then on traceability as well, you've got companies who are trying to make sure that people who, for example, say how they're going to use their RECs, prove to their auditors and to their stakeholders that they are using them in that way. And that's not just necessarily registries, but it goes all the way down to, well, how do my auditors see it? How do they prove that I haven't tampered with it? There's a great company here in Houston called Topple that's doing, that has its own chain specifically designed for traceability. And we've been having some really interesting conversations with them as well.
Yeah, and ours is, I guess, where we're seeing it is more on the revenue stabilization side. than kind of the traceability of settlements. It's looking at blockchain and really high performance computing in general as a way of kind of combining an additional revenue stream with renewable energy. So if you have a renewable facility, if you're long the renewable energy, either through a PPA, a power purchase agreement, or through the physical asset itself, the lower market prices go, the worse it is for you, right? So what's a natural hedge for that? Well, it's something that consumes energy, right? It's taking that opposite position. It's something that that has a benefit. The lower the market prices go, the easier it is to mine Bitcoin, right? Or the cheaper it is, not the easier it is. But if you look at the problem as one of converting electricity into high value computational outcomes, then really what you're doing is you're arbitraging between the price of energy and the price of Bitcoin. And you're saying, as long as I can make more than the cost of my electricity, right? If it's costing me $50 a megawatt hour to feed into the Bitcoin miner, but on average per megawatt hour spent on computation, I get X number of Bitcoin, and that's worth whatever it is to me. There's a spread there that you can capitalize on. And not only are you're adding revenue to your portfolio, but you're also that revenue is offsetting some of the exact periods where you'd be losing revenue on the renewable energy. And it's the same thing with the battery. So what we're seeing is, we've seen a variety of different applications. We've seen high performance computing combined with very large thermal generators. We've seen it combined with actually running generators off of natural gas that would otherwise be flared. Correct. And using the electricity from those local generators to run little, high performance computing data centers that live in a shipping container on site at the gas wellhead. And of course, we've seen quite a bit with renewable energy. So there's all these different applications of organizations that are thinking very creatively about blockchain. And again, I'll expand it to more than blockchain. We have companies that are, really it's server time, right? I've got some computational servers. I've got a satellite data connection. I can pipe data in and out, and I can do a bunch of computation very, very cheaply. And in some cases, those computational centers are even mobile enough to move around as market dynamics kind of change. And so it's a really interesting dynamic because there is a bigger need for computation today than there ever has been. And so if there's creative ways of accessing cheap computational resources, there's a huge spread in terms of the cost of the energy used to run the servers and the value that you get out of the computational outcomes.
Mm-hmm. Samir, anything else to add, or?
No, I think Brock covered a lot of ground there, and I think he's absolutely right. I think the biggest takeaway for me, again, sort of just academically, is just how fascinating this is. Every time we have a customer call and say, "Hey, we want to do X," sometimes I have to sit and decompose the thing with our team to really understand what they're doing, and it makes so much sense. It's just a thing that we hadn't thought of before.
Perfect. I appreciate that. And I see we're just about 5 minutes from the end of our time here. So I'd like to really get some deep thought around our takeaway question here. And that's going to be, and Brock, I'll ask you to maybe go first on this.
Sure.
What would you like the viewers to take away from today's discussion? And that's kind of a loaded question. We've talked about a lot. But for the most help that we can give our viewers today, what do you think they should take away and perhaps even look into more and ask more questions about?
Yeah, so, to me, the biggest thing, and this is certainly coming from the perspective of an analytics software vendor, but I think one of the most important things that we can acknowledge is that the pace of change within the energy industry is very fast today, but it's only going to get faster. It's going to accelerate. It's going to accelerate in terms of the products that are available, our understanding of the products and what we can do with them, as we've kind of seen today with some of the high performance computing and blockchain technology. And so at the same time, businesses are being run today in a way that is increasingly data driven. So you have an industry that is changing rapidly and accelerating in its pace of change, but you also have a need and a desire for analytics to drive business decisions. But you can't just go to a textbook and learn how to do the analytics that you need, because in many cases it's never been done before, because these problems have just cropped up, right? I think you'd be hard pressed to go and find a textbook on valuing a Bitcoin miner as a real option. What are the things you need to understand there, right? That's not written down anywhere. So you have to be able to adapt. So, and you're faced with a very challenging problem as an organization operating in the energy industry. I think the challenging problem that you face is that the industry is evolving so rapidly, and to stay at the cutting edge of that industry, you have to be making data-driven decisions. You can't just rely on pure intuition. And those two are almost incompatible, right? Because the faster the industry changes, the harder it is to develop leading edge analytics that stay at the forefront of the industry, which is changing really fast. So that requires a certain type of organization and a certain type of mindset to be able to keep up with that, right? It requires something that is extremely flexible. It requires something that is leveraging the latest technology out there. Something that's scalable, something that's dynamic, something that's flexible enough to be able to kind of integrate new analysis or new features in real time as the industry evolves. And that architecture, that goes to the very core of the entire organization. Because, the enterprise systems, just can't keep up with that pace of change. And so I think the one big thing that I want, folks to take away is, whether you're looking at analytics, whether you're looking at ETRMs, whether you're looking at any other vendor or system that you're integrating into your organization to help your business run better, it needs to be modular, it needs to be flexible, it needs to be high performance, because even if you don't need all of that today, you will. And so building kind of a system of systems requires these different systems to talk to each other. And so that requires a modular architecture with kind of API-based communication. And really, that's the only way to kind of scale into this very, very rapid pace of change.
Yeah, I'd love to just build on what Brock said. We in this changing environment, what blocking and tackling means is absolutely changing with it. But I think my perspective is that it doesn't have to be that hard to make the change. The differences are intuitive to Grok, despite the explosion of data. Like we talked about, power blocks maybe not being relevant soon. Hourly power means machines need to make more decisions than people do. It just may mean that you need modern tooling for which these problems are not at all hard to solve. A lot of modern tooling builds on Silicon Valley tool chains. And Silicon Valley has been dealing with huge, giant amounts of data for years. Maybe not quite as complex in some ways as what the energy industry does, but not dissimilar either. And those two tool chains make it real easy to solve some of these problems. So I don't know. I think this is going to be a fun ride for all of us.
If it's not fun, why do we do it, right? So before I hand over to Howard, gentlemen, thank you very much. Thank you for making my job so easy today. I know our participants, gauged by the questions we got and the answers you gave, got a lot out of it. I also want to thank Isaac and Stephen for the great material they proposed today, and how nicely it fit in with what we were talking about. So Howard, back to you. Thank you very much.
Well, you said it better than I can. Thank you, gentlemen, Brock and Samir. Thanks for your input. Mike, thanks for putting this all together and wrangling it and moderating it. You're really a hero this week. Also, thank you to Isaac and Stephen from JERA. It was a fantastic presentation. Please be sure to join us again tomorrow at 10 a.m. As they say, same bat time, same bat channel. For it, I'm sure is going to be an amazingly insightful discussion between some of the leading chief risk officers out there. We've got chief risk officers from Plico, from Vistra Energy, and from Musket, and this will be moderated by our good friend Bob Anderson, the executive director of the Committee of Chief Risk Officers, colloquially known as the CCRO. many of whose members speak and attend our various events. It's going to be a great look at the risk management challenges CROs are facing today. So with that, we'll say see you tomorrow at 10 a.m. and thank you again. And thanks for everyone. Take care.